All right. The meeting is preparing to live stream. I think we are live. This is the Investing Power Hour number 71 as we chug along during the dog days of summer here. I'm joined as always by Ryan Henderson. On these episodes, we talk about whatever we want, really, about the investing world. Probably going to be a lot of earnings this week. I know I got a good thing from a Substack called Necker Value about behind the curtains of Buffett's life. So a little bit of Buffett could be fun. I saw some good tidbits there. Ryan, anything on the docket for you?
I've been swamped this week in earnings and just work in general, so I haven't had as much time to kind of do that much reading. But I don't think last week we didn't speak about Amazon's earnings, right? Because that
No, we
was
didn't. Yeah, because that was late.
yeah,
Yeah.
that'll be interesting. And then Icon Enterprises, after the short report, um, they ended up having to cut their dividend by 50%. So looks like, I mean, that's really all I know about it. So I guess that's my whole story. But
We're gonna have to cover the poster in my behind me here.
yeah, for
But yeah,
those that
the
don't know, for those that are listening, Brett has a poster behind him with Buffett, Munger, and Carl Icahn. So it aged poorly.
it did. It has. Well, the story's not over yet, but it seems like they're in a tough situation and kind of strangely got ahead of their skis there. But Ryan, why don't you want to talk Amazon first? Why don't you go first on that one? What were your thoughts?
Well, I thought it was a really good quarter, same as everyone else. It's one of those, them and Google, it just feels so easy to own. And it's funny, like the Magnificent Seven, we kind of avoided owning for a long time. Not necessarily on purpose, but I don't know. Maybe it was just because they were so big. We kind of thought, what's left in terms of like edge there? What kind of like, can it really grow that much? And I gotta say, switching teams and moving to the cheerleaders for the Magnificent Seven, I am all on board, because now I look at all the takes that are like, you can't beat the S&P owning the Magnificent Seven. You got to be in like small cap and special situations, and I'm like, no, that just isn't true. Here we are. It's Amazon had a great report, and it just kind of reminds me how well some of these companies are really run, and kind of the vast resources and the advantages that they have now at this point. Amazon's retail business turned to profitability. I question whether or not, I mean, advertising is included in there, and that's $41 billion of pure margin, pretty much. So I question how profitable the actual retail like delivery business is. Probably not very profitable. But I mean, advertising is a part of that business. So in aggregate, it was profitable both between the international segment and the North American combined, which is a huge improvement from last year. They talked about the cost savings that they're generating, moving to like these new smaller regional hubs instead of one big national delivery network. AWS reaccelerated, I guess, or it's like
No,
stabilizing.
that
Stabilizing.
stabilizing, reaccelerating is not the right term, but I guess it's stable.
Reaccelerating relative to their expectations from last quarter.
Yeah, the third derivative is coming into play there. No,
It's no, okay. I mean, Willis Cap on Twitter had this take that
I think he
kind
was
of,
semi joking, but also not.
yeah, it was when Amazon was, I think it was like in the 90s, like not like $90 a share area. He basically said, fast forward 1 year, AWS has reaccelerated, retail is profitable again. Amazon's a $200 stock. Now, it's not a $200 stock, but I think he may end up being right on both those two big assumptions. And I'm kind of bummed because we sized the position pretty small. We own it, I guess, for anyone that doesn't know. And to be honest, it was my caution that ended up leading us to sizing it too small, because I was worried that retail just wouldn't be able to just turn the corner to profitability. Dead wrong. I think when you got a fast pitch, bet big, and that was, I mean, hindsight, clearly a fast pitch or a fat pitch.
Yeah, we'll let it slide. Or I guess the other I'm the only other person on the investing team, so we've talked about it's important to not, you know, everyone's gonna have mistakes. I made plenty of them. The I think the one thing I'd push back on you there is that I don't think it's that retail is necessarily unprofitable. It's that they're still profitable despite the fact that they're investing a ton in Alexa, they're investing a ton of these generative AI things for whatever reason. They're investing a ton in this healthcare stuff, Project Kuiper. The list goes on and on and on. We actually did we tried to compile every single other bets they were doing during one of our not so deep dive episodes. I think we did that right at the beginning of 2023. And it was actually much bigger than I even thought. So when you combine the fact that third-party sellers are growing at close to 20%, advertising is growing 20%, subscription services are growing at a double-digit rate, I think it's pretty clear that retail could grow its profitability for a long while if they wanted to. But I think the big concern still is going forward whether they waste a lot of money on these things or some of the stuff like Alexa, everything outside of the retail and AWS segment or the core retail and AWS segment never really materializes and gets a positive return on invested capital.
Yeah, I guess that's a good point. The retail's definitely got to be profitable if they're losing money in all those other segments, because I mean, I don't know. I guess you kind of forget about them just because of the way they categorize their revenue, North American, international, and AWS. And so I always think like, I guess I just paint it as North American retail, international retail, and AWS, but it's really kind of a lot more under that hood. So yeah, third-party seller services is growing like a weed. Advertising services growing like a weed. Those two both have to be pretty
Good margins.
higher margins than their core business. So
yeah, I think if third-party sellers and advertising is growing at more than 10% or close to 20% like they have this quarter, it'll be pretty hard to lose money over the long term as long as AWS isn't dead like people say, which I think was interesting. The context there, again, we really give ourselves a big handicap on AWS because we're not experts in that industry. We really keep ourselves off footing there, so we really wanted to invest in the stock when we could buy cheaply, a business that we do understand, which is the retail arm. But the note they had on AWS was that like they tried to put into context for the investors where they said that everyone's pulling back, they're optimizing spend for their customers. And so they're decreasing costs for a lot of their customers that were existing, but they still grew revenue 12% on a giant revenue base. So that means like they're trying to hold everyone's hand and say, hey, look, we're still attracting a ton of new customers that are going to eventually start getting a nice dollar-based whatever. They don't give out a dollar net expansion rate number, but they're going to eventually start spending more and more with us as they grow over the next 5-10 years.
we do have a question in the chat from Mark USA. Says, can't stay for the live show, but we'll catch up later. If you guys could give your quick view on Nelnet earnings, it would be appreciated.
Yeah, we'll keep that note. Yeah, that'd be fun.
We haven't talked about it yet. What were your thoughts from the quarter?
Yeah, well, do we have anything else on Amazon? I think that was all for me. Pretty steady, no big surprises. Anything else before we go to Nelnet?
No, I thought it was a pretty dang good quarter across the board. It's fun to have Andy Jassy on the calls. You kind of quickly realize how competent he really is.
I golfed with a random guy in Seattle who worked with him and said that he was the smartest guy he ever met. And I guess it's probably true listening to how smart he is.
Yeah. And I've kind of been looking at the numbers, revisiting them for some articles I've written about Amazon, and they spent $41 billion in CapEx in 2020, 61 billion in 2021, and 63 billion in 2022. I just don't know any. And now I'd say probably half of that, maybe 60% of that has been like fulfillment network delivery. And the other half, and there's other stuff in there as well, but the other half is kind of server space for AWS. I don't understand how companies could compete with that. I mean, Microsoft maybe on the cloud front, but there's no delivery business that's going to be able to invest that much money. And it's just kind of, as long as they have the right people in there and they're willing to invest that much money, they're just going to deepen their moat every year.
Yeah. I think one concern in the near term is that the UPS contract got revised and the salaries got raised a ton. So that could maybe put a lot of pressure on the wages over at delivery warehouses, that type of stuff. But they
Did
get
you
a lot of
see
flack
that?
for that. They get a lot of
Did you see
flack for
that thing
that.
about that? What do they deliver? 5 packages an hour? You see that tweet or whatever?
No, I didn't.
It was one of our, I guess, idols, Jason Kalaknis. And we don't usually, I'm not criticizing by name because he's had some takes that I like, takes I don't like. I have nothing
He's
wrong
definitely
with. There's
not
nothing.
the
He's not the worst.
of the all in pod, he's maybe the one I like.
Yeah, he gets a bad rap sometimes, I think, but some of that's probably self-inflicted. He had this like tweet. He's like, can't believe UPS drivers are making this much money. He's like, he tried to do the math to like, what's the revenue per package they deliver? And he's like, how many packages are they delivering an hour? What, 5?
Oh boy.
Everyone was
Yeah.
like, okay, so he's never worked a labor job.
Yeah. Well, that's how it goes. I think they should get paid
I do think
a
sometimes
lot more than they do, but
yeah, I think, I
it's a hard
mean,
job.
they make everyone feel great whenever the people see them. Their packages getting delivered. It's fantastic. And it is a hard job. But I think sometimes all their tweets, it's like, okay, this makes sense. And there's one crazy thing. And then it's just engagement bait. And it works.
That's true. Well, now that you get paid for that,
Yeah,
what
that's true.
what do you think you're gonna do for engagement bait? I always do well with stock-based compensation stuff, but it never really goes fully viral. It's too niche.
I might do just big tech, like,
Oh, and just tweet about big tech.
cheerleading. Yeah, I did like a tweet about like Google's cloud operating margins and how they've improved. And it just like goes viral because I mean, those have the biggest shareholder bases and people just want to like, cheer for their companies. So
Yeah.
I think maybe we got to start hopping onto the Tesla, and if you tweet positive things about that, it's another big shareholder base. You just gotta,
Buffett quotes, gold,
e-
crypto, Tesla.
even
Covered.
if you don't have any investments in them, just tracking them and tweeting stuff about them, you're gonna get more engagement.
Yeah,
Sorry, our Nelnet tweets don't really seem to do a whole lot.
that's true. There's about 10 of us on there that follow the company, but that's a good segue, Ryan. What do you think of the quarter? Seems pretty standard to me, except they're just getting their net interest margin is getting compressed like a lot of other financials. So they'll hopefully work through that.
Yeah, it's kind of hard to have a whole lot of takeaways from this because, first of all, there isn't always that much color provided. There's really not a lot
Yeah.
of color provided at
Like
all.
why did it happen? Why did anything happen? They don't tell us.
Yeah. And so you kind of, it really is, and I hate saying this, but it's just a bunch of trust in management, essentially, is what you have to have. And um, they've proven that it's worth trusting them, but the gap numbers are kind of, yes, the net interest margin was getting compressed. So that's a bummer. Plus, just the student loan book is shrinking. And then on top of it, the student loan servicing, it's not going to factor in the, what do they call it? The end of the moratorium, which is going to be September. I think it's official this time. It's going to be September.
Yeah.
So that'll kind of help the loan servicing segment. And then I don't know, the headline numbers looked kind of bad, but if you look at the underlying businesses, everything looked pretty good. I thought they were
Their gap net income is always choppy.
Yeah, they were lending a lot at the bank, although it's still a small part of the business. They grew the Nelnet business services quickly. Revenue was up, operating income was up there, and loan servicing is kind of in a weird middle ground right now. But all in all, I mean, I didn't really have a whole lot of takeaways. I think a lot of the shareholders are the same here, where they see it and they're like, I don't know what to do with this. And the stock just barely moves.
Yeah, I saw it was down a little bit. I think people may have been surprised with that margin compression, but yeah, I kind of throw my hands up whenever there's a quarter for Nelnet. It's more of kind of looking at the long-term trend. I like to track maybe book value growth. I think that's not a bad thing for a company like this. They're also making investments. I like to track what they're investing in because they kind of give that out. I think they made a decent amount of new solar investments this quarter, which is interesting. So keep tracking that. But besides, there's not really much else. The loan book's going to do what it is. The loan servicing is kind of paused. I think another KPI I really like to look at is you said business services, but it's just that education software and payment stuff. I really like to look at revenue for that because that is high margin. That is one that's pretty easy to understand what the margins can be for them there. So the fact that that's growing pretty quickly was probably the biggest highlight for me.
Yeah. Sorry if we don't have any more exciting takes, and sorry if you've already left by this point because I know you for the whole live show. But I guess what else do you have? What anything other news wise?
I did see, I guess no one cares about inflation anymore, but it came out today. Can you guess what price was inflation lower in July, or is it July? Yeah, lower in July than June, or higher in July than June? What do you think, Ryan?
I have not seen it, so I'm gonna go ahead and guess higher.
It was higher. Prices rose 3.2% in July from a year ago, outpacing June's inflation rate of 3. So
yeah, I felt that. I felt that in the bank account.
yeah, the 0.2% change. Yeah, I don't have any other takes on that. It seems like that's pretty boring right now. I do
You know who else
have
reported? Coupang reported, and we just had our show that came out on them. Came out
would
3
check it
days
out.
ago.
Yeah, would check it out.
I highly recommend it. And that quarter was,
Another good
I
one.
mean, it's one of those things that doesn't, where all my concerns from the episode, I was like, I don't really know if I believe the margin expansion story. And then 2 days later, they crushed expanded margins. So
They
I'm
expand
like,
again. Yeah.
it's a little frustrating, but yeah, I think the thing that really stood out to me was they doubled their capex. I think it was like 160 million last year to 320 million this year. And they still took free cash flow margins from negative, I want to say 4% to, let me double check. I wrote it down somewhere. It's like negative 4% to 8%. Yeah. 1,200 basis point improvement in free cash flow margins while doubling their capex.
Yeah. What do I like to say? A working capital advantage will give you capabilities some people may consider unnatural. That's the meme I like
Star Wars quote.
Yeah. It's totally true. And it seemed like a great quarter. Yeah, we're still on the watch list for us. Would like to get it at a better price. Maybe it's one like Airbnb that's just going to be on the watch list forever because everyone just keeps at the premium valuation. But yeah, I think it's a great company. They're investing in Taiwan, which I think is interesting. They said that they're seeing good results there, but they're still, it's going to be early days. So that's impeding margins as well. But they're doubling, I think, their investment there. I can't remember. I don't have the numbers in front of me. Which I think is a great sign. Overall, good quarter. Yeah. Not much else. All right.
What else do you
We
have?
got a comment from Mads Capital on. He's a fun Twitter account. Glad that you guys are on board. The shift from first party to third party and ads were the main reason I flipped bullish in May 2022. Historically, they've teased margin leverage after investment cycles too. He says need something to create engagement for FinTwit that Nelnet can't. LOL. Thank you for the show. Yeah, well, we do have to start calling it.
He's great at that. He just did the value trap basket and just did a whole bunch of very popular tickers.
That's true.
It's bound to get engagement.
I think if we called Nelnet the next Berkshire, that's what I always do for the Motley Fool. So honestly, that could work.
I just feel so crummy when I say that sometimes.
Yeah, but do you like getting article bonuses, Ryan, or not?
Yes. What was I gonna say here? Yeah, I mean I couldn't find the quote, but I thought there was a time when Bezos was still around where he's like kind of said something along the lines of buckle up. This is gonna be a huge investment period.
That was right at the start of COVID. First quarter earnings call after COVID.
It was during the call.
I think so. Or the letter or
I
the
didn't find it
earnings
in the
release.
letter, so I think it must have been in the call. But he said that, and everyone's like, "Oh yeah, okay, here we go, big investment period." And then the
Yeah.
investments happened, and everyone's like, "What's going on? Why are we unprofitable?"
Yeah. And then they blame Jassy.
you know, like bring Bezos back. We need him.
Yeah. All
He's the
right.
one that
Yeah.
wanted to do all this.
Yeah. Mads Capital says, I'm sorry for that, guys. Match will make a comeback soon. He put that in the value trap basket. It's all right. I think honestly, there's a couple companies this quarter, Spotify, IAC, that were pretty disappointing. Match, really not. So I'm feeling good about that one, but maybe that's, it's a trap kind of thing.
Yeah, there was some bummer quarters. You know what's funny is Match I thought had a good quarter.
Yeah,
It was
I would have guessed the stock would be in the 50s, but I can never predict it.
Yeah, the other thing that I found kind of ironic is if you look at the IAC shareholder letter, he's like, uh, he said Joey Levin says something along the lines of, "We're up on our buybacks."
Oh yeah.
Like, and he's like, not that that matters, but it's better. It's nice to have it positive instead of negative, just because they bought shares at like, I don't know, it was like average of $52 or something like that, and the stock was at 60. And then like you wrote that, and now the stock's got to trade back down to 52.
Yeah. I think let me pull it up right now. Oh wait. It's at 58, but still it did collapse a lot right after they reported.
Yeah. I mean, I guess it was right, but you just don't even need to put that in the letter.
Yeah, I'm all for that buyback, but yeah. Okay. Well, do you want to talk about these interesting nuggets from interviews with Alice Schroeder, who wrote The Snowball?
Yes.
Okay. So for anyone that doesn't know, she wrote the big biography on Buffett, the one that's the most popular. She spent, I think, estimated 2,000 hours with him over what had to have been multiple years, profiling him for the book, interviewing everyone. But when it got published, Buffett may have thought it got too personal or something like that, too much into his personal life. So he kind of got really mad at her and hasn't really talked to her much since. So she, I guess, is a little open about not just being positive about stuff he does. So there was this interesting quote or article from Necker Substack. The guy that writes it is Frederick. I can't pronounce your last name. Excuse me, Gishin. He's on Twitter. I think he's German, so hard to pronounce your name. Apologies, Frederick. But there were some interesting quotes here. So let me just find one about. I got to scroll down here. Okay. The importance of Charlie Munger. So basically, she said that his biggest weakness, this is the quote here, his biggest weakness is the flip side of his strength. He is very rigid and he doesn't really listen. He has incredibly firm convictions and is often right. But when he's headed down a wrong track, he tends to not pay attention to contrary information. And that's one of the roles that Charlie Munger plays that is really important, is he is one of the few people who can tell him no or actually say you're wrong, and he'll actually listen to them. I thought that was interesting, but it seems what's weird is he always praises and talks about, like, all right, you got to be open, you got to admit your mistakes and stuff like that. But in reality, he has the same problems as everyone else, is getting, too much into your conviction.
I thought you were explaining Munger at first when you said that. I was thinking Alibaba.
That's true. It's
But
probably
I
the
bet
same. I mean, we're all the same. So
yeah, I bet they balance each other out pretty well.
yeah, here's another one that I thought was quite interesting, where it made me, I don't know if it's hesitant, but kind of shows that his early stuff may not work today. So she was basically asked, would Buffett not be as successful today? The first one was basically he would now do the work. Back then, he would do the work that a lot of people still do today, which is kind of talking to people, finding all this stuff, and the internet made it a lot easier to find all this information. But the second thing that apparently he did is he was uncommonly good at going around and talking to management and getting them to tell him what their business plans were. This used to be perfectly legal. In fact, the insider trading world has evolved a lot, and he was great at finding out if there was a tender offer coming or something like that, and you cannot do that anymore. So I don't think he probably did not like her explaining that to the public, but I guess this was legal back then, and he was a little bit more aggressive than I think a lot of people who just know him as the Berkshire Hathaway CEO would present themselves as.
Yeah, that, I mean, it doesn't paint him in a very good light, but it doesn't necessarily surprise me all that much. Reading Snowball, you kind of got that sense because,
Yeah.
I mean, if you look at that scorecard in those early days, he was putting up numbers where it's like you can't just pick lucky stocks. Like, you have to have a sense of what management will do. And I mean, I think it was more accessible. There was just less competition back then, so maybe it was a little easier to get access to some of these management teams.
Yeah, and
some of the times he ended up being the controlling shareholder.
Yeah, yeah. And what's interesting is it wasn't. It's the informational advantage that helped him a ton in the early days, right? It wasn't the only thing, but that is slowly gone away. So I think trying to learn from him, it's kind of tough because, okay, the information now with the internet has just been democratized everywhere, and it's really choosing what information to look at. There's the information overload that people talk about with investing. So it's honestly flipped like 180 degrees, where now it's, and they talk about this in one of the quotes here, was talking about how, and everyone knows this, he goes to the office, puts on CNBC on mute, and then reads with the blinds down. And she made a joke that he doesn't need sunlight or something like that, where it's about not getting, the wrong information and all this crazy information out there that you can just get an endless overload on. So it's the complete opposite as of what it was like in the 40s, 50s, 60s, I think.
Yeah. And I mean, let's not pretend like he isn't putting up solid performance today. Like, his investments,
of course, yeah.
Today, there's no information. He didn't have an informational advantage on Apple. He didn't have an informational advantage on Coca-Cola, kind of some of those really strong performing investments that were kind of his second act. Those are still good. And the other part is, yes, he adapted his style the way he needed to, but let's not pretend like getting that informational advantage, he wasn't a byproduct of him working harder than most people, because he worked way harder than most analysts, investment managers out there.
That's true. That was pretty clear from the Snowball as well. All right, here's one more, or maybe there could be a couple. So she was asked, how is Warren different from other investors? First one is to talk about behavior, but I think the second, she gave it 3. The second one is quite interesting. Here's the quote. His knowledge of business history, politics, and macroeconomics is both encyclopedic and detailed, which informs everything he does. If candy sales are up in a particular zip code in California, he knows what it means because he knows the demographics of that zip code and what's going on in the California economy. When cotton prices fluctuate, he knows how that affects all sorts of businesses and so on. So that's one that I don't think people can really learn from, is just having a crazy memory. But I thought that was quite interesting, where he talks about, again, he's like, oh, anyone can do what I do, and anyone can do this. You just have to have a nice psychological temper. You don't have to get over emotional, and you just buy business at a cheap price. But in reality, I think a lot of what made him successful is that he was just incredibly smart. But he can't say that to the national audience at the shareholder meetings now.
Yeah, I mean, certainly gifted memory wise, but once again, it does, like, he read voraciously, and frankly,
but I think, but
like 90% of his waking hours.
Yeah, but here's the thing: it was like 12 hours straight a day, and that's literally not possible for 99.9999% of the population. Like, I can't do that. I can only do a couple hours a day. So
and it's also, I mean, half the time people don't even have the opportunity to do that. Like, they have other
Well, he did, yeah.
commitments.
I mean, he did sacrifice basically anything else in his life, family, any sort of vacations, whatever.
Yeah, I mean, spent an incredible amount of time or dedicated an incredible amount of time to it. But I mean, he still has relationships with all his kids and all that stuff. So it's not like it's not like
I
he
mean,
doesn't see them.
yeah, it's true. That's true. I don't think we want to get into that. All right, here's another one. The third part, which he said separates him, is the way he looks at business models. This one I think could be replicable. It's something to learn from. The best way I can describe it is that as if you and I see an animal and he sees its DNA, he isn't interested in whether the animal is furry. All he sees is whether it can run and how well it will reproduce, which are the two key elements that determine whether its species will thrive. So I think that's a good one, is kind of having that mental or muscle memory of looking at businesses, what ones are successful, having that pattern recognition of, okay, what are the competitive advantages? How are they going to last? Blah, blah, blah. I think that's one that a lot of people can learn from. That's one that we try to continually get better on as we study businesses, for the podcast.
Yeah, I'd like to think that we've improved on that over time, getting a better sense of like the fabric of what these businesses really are and what's important in terms of driving their performance over the long run. I think it's kind of interesting that we looked at AutoZone today because we're going to be talking about that probably in a couple hours here for a not so deep dive. And it's one of those where how easily can they reproduce? I mean, it's replicable. It's a simple model. They grow like kind of at just a consistent rate.
Little teaser, probably best. We've had a streak of great management teams. Coupon, I was like, this may be the best managed team of new companies. AutoZone could be the best management we've ever looked at.
Yeah.
All right.
Yeah, I wonder if he's ever been in. It seems like a Buffett style.
Yeah, maybe he never got cheap enough. I don't think he likes retail as much. Remember, he kind of was hesitant on Walmart, and he should have bought that. I think he would maybe say the same thing about AutoZone. Maybe it's something he didn't understand as much. Maybe he didn't like the automotive market, but I think he's just really hesitant on retail.
Yeah,
he definitely can understand it. He understood Walmart, but he's just hesitant compared to something like Coca-Cola or American Express, which are a little more capital light.
I think
here's the
go ahead. I was gonna say, and it's funny, AutoZone and Walmart have very much a similar blueprint in terms of what made them successful. I think they were actually friends, Sam Walton and the founder of AutoZone. I think Pitt Hyde was on the board of Walmart for a long time. So yeah, it feels like, I don't know. It feels like a simple business that he would have understood though.
Okay. Yeah, I understand. Or I agree. I didn't mean to say that. I definitely agree. The last part here, I think this is one that anyone can take away from, any listener here. 3-step investment process for Warren Buffett. This is from her Reddit AMA. First one, I think we can all take away from this. We try to basically base our investments off of this kind of thing as well. First, is it an addressable investment? He rules out a lot of stuff that has too much tail risk, or he has no edge on in the market. For example, thinking he can be smarter at buying Johnson & Johnson than everyone is essentially market timing. Warren rules that out unless he has some insight he is convinced no one else has. Example, probably Apple. He may not always be right, but his approach and works over time. So basically, do you understand this one? And is it understandable for you? So something like that. Second, downside protection. This is probably one that we would hopefully needed to learn earlier. He looks for multiple ways to avoid losing money. If you look at the preferred stock deals he did after the financial crisis, he fenced in these companies and built in so many ways to avoid losing money, it was almost funny. He will pass on huge upside opportunities if he can't get downside protection. I think that's one a lot of people take away from, and it's hard to understand and it's hard to do, but I think it's one you want to probably reiterate time and time again, and we try to reiterate.
Yeah, I don't think most people can build in the kind of margin of safety he was able to do in the later years, because I mean, he was like you said, yeah. I remember that, what was it, the Harley Davidson preferred? Yeah. Like you basically structure it so that you're the first person to get paid kind of thing. But it's yeah, that's definitely something we've failed to do at times.
Yeah. All right, last one. I think this one is one that is really important when identifying an investment opportunity, especially if you're kind of in the same Buffett type buy and hold camp, or buy and hopefully never sell, is capital generating power. His focus is on how much capital an investment can produce that can be either reinvested within the business or elsewhere. So what she means by this is either the company has a long reinvestment runway at attractive return on invested capital, or they're going to return it to you through dividends and buybacks. That one is so simple, but I think is always underrated.
Yeah, that I think the reinvestment runway is kind of an interesting one because identifying it's harder than the identifying the moat. I think it's pretty easy sometimes to identify when something is competitively advantaged, but a moat isn't that good or isn't that useful if you can't, like, returns on invested capital is nice, but you have to be able to invest that capital. And I think that's harder sometimes to assess. Like, okay, I'm going to go back to the AutoZone example because we're talking about it today. Clearly, they generate good returns on the money they put into new stores, but they've got 6,200 stores in the United States. They've got 700 in California, 700 in Texas. Is there really room? Like, I guess I don't have a good sense on whether or not there's still room to invest more capital in the US and kind of put more stores down, or I don't understand the Mexican market, which is their second one.
Yeah, well, I'll hopefully help you out there, as I was the one that's covering the industry there. It might be a little more attractive than you think, or maybe the layperson thinks, as you'd probably think it's a more mature business. But I totally agree. The reinvestment runway is sometimes harder to evaluate, which is why I think the margin of safety with that is buying at a cheaper earnings multiple with a management team that will continue to buy back stock if the stock remains cheap, that's where a lot of your returns can come from. If you buy a stock at a 10 times earnings yield, or 10% earnings yield, they continue to buy back stock, it remains at a 10% earnings yield, and the business is durable. So, or growing, flat or growing, you're going to have decent returns. All right, here's maybe one other one, and I think this is one people know a lot about, is his disqualifying things, his quick, judgments on a business opportunity or an investment opportunity. And she said, typically, and this is not well understood, although I think now it's understood, his way of thinking is that there are disqualifying features to an investment. So he rifles through, and as soon as you hit one of those, you're done. So she says, don't like the CEO, forget it. Too much tail risk, forget it. Low margin business, forget it. Stuff like that. I think that's one that a lot of investors can take away from, where, yes, like if you don't like, if the business looks great and the CEO you don't trust, the stock can still do really well. There's plenty of examples that we've had over the last 5-6 years of CEOs that make us nervous. They've done extremely well. I think it's probably even more prevalent during this time period, but I think the key is, if you don't trust the CEO, you're not going to be able to trust if the stock draws down over 50%.
Yeah. I mean, that's where I think insider ownership is such a big part. And I guess how much are they getting paid relative to their actual performance? It's hard. If someone asks, like, what are the red flags for a CEO? Like,
I
what
can't
makes you
tell him.
dislike?
I just don't like him. I just don't like him.
I know,
literally
it's hard
listened
to
to them.
say.
I listened to the AutoZone call, and I was like, oh, this guy's legit. He's not a liar.
Yeah.
Like, he's just honest. There's some I listen to, and I'm like, you are just trying to make yourself look good and then get paid.
Yeah.
PayPal.
I mean,
PayPal is a clear example of that. All no names there, but the entire team.
Yeah, 100%. I'm not sure. You kind of, it's hard to describe, like, what exactly makes one a good CEO, but when you see it, you know it. And I think you just have to study a lot of them to figure it out. But the AutoZone one, maybe it was, did you listen to the recent conference call?
Yes. Yeah.
I don't want to belabor over AutoZone too much, but there was one of the analysts asked a pointed question, and he's like, that was a very interesting way of phrasing it, but I appreciate your question.
Yeah,
And
and he was like, they were like, well, you lost. Yeah, they're like, commercial's growing slower than one of your competitors right now. It was a bad quarter on commercial, and he's like, to be honest, you are right. Like, we need to be better, and that's all he said. And it's just a refresher because a lot of times management teams will try to spin it, throw you through the spin cycle on that. But I think that's enough Buffett. That was a fun segment. Ryan, you had something else here. Disney earnings, maybe Roblox could be fun. But if you want to talk Disney, I can maybe pull up some Roblox numbers because we haven't looked at that at all.
did I
While you're
have
doing
that?
that,
Should I have that pulled up?
I thought you had Disney in the file here. Oh, never mind. You had Icon. Well,
No,
I thought it was
but we
Disney.
can talk about Disney. I honestly haven't looked at it.
Okay. Do you want to pull it up?
Have
See what the numbers
yeah. Have you taken a look at it yet?
were? Besides seeing a few charts on Twitter, no. I think it was bad, but that's enough. Well,
Let's walk through it right now.
Speaking of the spin cycle,
Yeah.
I mean Disney every time.
I literally just, I don't know. I just look for confirming evidence whenever I get Disney because I don't really like Bob Iger, but okay. I'm going through it right now. Sorry if you hear clicks in the mic.
No, I don't hear it.
Revenues grew 4%. Okay. Let's just go to the segments because I don't know. Segment results. Entertainment, media, distribution. Okay, so basically streaming and everything else.
Yeah, TV
down
movies.
1%. Parks, experiences, and products up 13%.
Damn.
God, it's so consistent. They amortized. What's TFCF?
No clue. Their earnings reports are hard to decipher, honestly. I think you know what's funny. This is another red flag. They changed their segments again.
That is a big red flag. It really upsets me. Okay, here's the other thing. Look at these adjustments. It's saying segment operating income is 3 point. What segment is this for? Total segment operating income, 3.6 billion. Actual operating income, negative 134 million. The adjustments here.
Wait, what segment operating?
I think it's like
parks or both.
Looks like it's
combining parks and TV and movies.
I don't know. I think it's both. Yeah, it's both.
Okay, so the segment is positive, but when you add in corporate costs.
No, when you add in 2.7 billion in restructuring and impairment costs, 300 million in interest expense, 400 million in amortization of Hulu intangibles and TFCF, which I'm blinking on what TFCF is, plus 295 million in corporate and unallocated shared expenses.
I never liked that because those aren't one time.
It's just, I don't know. I mean, it's the same problem that it seemed like it started with. I guess here's something interesting. DTC revenues were growing 9%. So that's Disney Plus. Linear networks declining by 7%.
They're raising price. They're raising
$500 million in DTC losses.
Okay, so it seems
which is an improvement.
Yeah, and I think the parks is fine, right? It's gonna be steady. They're making a big bet here, and they're raising prices on their streaming offerings. They're also trying to push people into ad or separate the cost between ad-free and advertising supported. So I think maybe pushing more people to the advertising side. Do you think they can raise prices like they have on Disney Plus, Hulu, ESPN Plus? Because I don't think they really can.
At Disney Plus Core.
So excluding India, excluding Hotstar.
Yeah, so no Hotstar, no ESPN Plus, no Hulu. They grew subs 1% while increasing average revenue per sub by 2%.
Yeah.
Well, I don't know. It's one that I flip flop on all the time, frankly, because it's like, obviously they have good IP, but the value of that IP when people are producing, when Netflix is producing new content every month, HBO is producing new content every month, and it's getting more and more competitive. Like, I don't think the back catalogs really matter that much anymore. I know maybe it's different if you have kids. I get that. But
That's a small subset.
you're also competing with YouTube in a big way.
Oh
And
yeah.
so it's just the streaming one is difficult to wrap my head around. Obviously, Parks is a good business, but I just would have absolutely no way to forecast how many subs could they have, how much would those subs pay, and how much would it cost to make those subs happy.
Yeah.
Like, there's no way to know for me.
And it's just going to get worse and worse, or not worse and worse. It's going to get harder and harder to make up for the losses in traditional TV because that revenue is just going to decline and decline and decline until it goes away. Sometime, I don't know when, but
They also ESPN Plus lost the MLS contract at a bummer of a time.
yeah, bad
Apple
timing on that. I mean,
Apple called it out.
that's not really relevant, but it's
It
ESPN.
may have been to paid subs.
It could, yeah, for sure. For ESPN Plus paid subs, they would have probably boosted probably like 5-10 million for sure.
Yeah, because Apple's getting I they gave out some of the numbers and they said it was definitely helped by Messi coming, but they're also paying a lot more.
Yeah, and to the business, it wouldn't affect anything.
For Disney overall, absolutely. Yeah, no way. But or even Apple, absolutely not. It's
Yeah,
just I mean, maybe it would make it's kind of a good example of having a business built on sports streaming rights is not good.
Yeah, or by itself, like Amazon can make it work because it's not
It's
core.
A part of a holistic bundle, yeah.
Yeah, it's driving kind of a holistic advertising offering, really. Yeah, it's Disney. I don't know, man. I don't know. I don't know what they do. I think they made the big mistake of pumping out too much stuff when they had to have been more like high quality, low quantity. That's how they should have succeeded. And yeah, that gets you less revenue and earnings in the short run, but it creates you up for much better. Because now when any sort of Disney property comes out with something, and I guess Star Wars is pretty on the movie side, low quantity, but they've been so bad that people don't like them as much anymore. But when it's high quantity, people don't think of it as an event, and you don't really get it talked about. Like, what if they made 10 Barbie movies? No one would care anymore. But when it's that one, when it's that unique thing, and when it's, I don't know. I think Disney's in an impossible situation. But I'm gonna give out some numbers on Roblox. I know this is one we've looked at before. It's kind of been on the watch list, but sort of not. I'm gonna give you some numbers here, and tell me if you like the quarter or not. So bookings, which is their revenue figure, $781 million, up 22% year over year. Cash provided by operating activities, barely positive at 28 million. So kind of break even there. Free cash flow, negative, slightly negative, but they got a big cash buffer, so they're okay. Daily active users growing 25% year over year to 65.5 million. If you look at DAUs by region, they're growing across the board. If you look at hours engaged, up 24%. So in line with DAUs, they're engaging with the product. Average booking per DAU is declining, I think, as they move into more international regions. What do you think, Ryan? Stock was down over 20% on this, and the market cap is currently just $18.5 billion. Still not super cheap versus that bookings number, but Roblox looks interesting. They continue to grow, continue to execute. Seems like a good business.
Well, my only concern here is I thought last quarter Dave Baszucki kind of came in and said we're going to start to moderate costs.
Yeah, he said, well,
we're going to slow spending or whatever, and we're going to start to see the operating leverage. And it does not sound like they saw that at all.
Yeah, I think it's tough to have that happen in one quarter because it's not a overnight thing, but I believe they said it was going to happen within the next, by early 2024, next few quarters, start seeing it. But I guess you can never. That's a tough situation, as we talked about with Amazon. It's hard to get conviction that the margins will expand if they aren't, because like the betting on margin expansion is hard, because for multiple reasons, because it's just hard to, like, how is the business model going to be structurally changed? There's a lot of friction in changing a company's cost structure. We'll see.
Hey, last quarter, cash flow on 770 million roughly in bookings, cash flow was 174 million.
Yeah, I mean, I think it's just timing.
Yeah.
I mean, Q2 is always low outside of the pandemic. I wouldn't really. I would take a trailing 12-month basis on that.
Maybe
Summer's weak. Summer's always weak for them because of summer break.
Yeah, it says we are entering an exciting phase of our business. As a result of our hiring over the past few years, we now have a robust, mature product development organization. We believe that with the momentum we see in bookings, we can now begin to slow our year-over-year increases in headcount and compensation. Should see operating leverage. Yeah, I guess it'll take time, but I mean, I like the business, and my biggest concern when the company IPO'd was that there would be some sort of fluctuation in terms of engagement, or that maybe it was just kind of like the Fortnite of the modern day, because I know there's games within the games. It's kind of its own little digital universe, but at the end of the day, people are clicking on Roblox versus clicking on other games, clicking on other apps, choosing to spend their time there. So I thought maybe something would have come along and replaced it, but all the engagement trends have gotten better. And they've got, like, what is it? Freaking 70 million daily active users that spend like an hour and a half on there a day. So
yeah. And this is one where I think the moat, it's easy to track whether the moat is widening, because if hours engaged are growing, I think the competitive advantage widens, because if there's more hours engaged, that means there's more time for their developers to make money. So yeah, I think it's 100% not to YouTube's moat yet. And I think YouTube has one of the strongest moats in the world, but I think their end state could be there 10 years from now. I'm just not totally convinced it's going to happen.
Yeah, and they've gotten to older users too, or they've aged up with their users as their users have gotten older. I still don't think it's ever going to be, a 30-year-old platform, but they're starting to capture more of the teenage demographic and 16 and up.
We'll see, though. We'll see. Yeah.
Which it's interesting. I don't know how, like, 14-year-old versus a 7-year-old, is there that much higher of a propensity to spend? Probably not. But 30 they generate plenty of bookings. I know, but you think they're going to get to 30-year-olds? If there's 30-year-olds on the platform, they're probably not the 30-year-olds you want.
I don't know if they change. Like, there's a lot of stuff of changing, not, how it's like Minecrafty little kid type stuff now, but they're building a lot of tools for more professional style developers to build stuff on there. So I think over time they can build stuff where that's basically equivalent to what the publishers that 20, 30, 40-year-old people are playing. I mean, so I see no reason why people want to play that. Happening. Yeah, but it's going to take multiple years. And they said that their fastest growing demographic is 17 to 24. And as that ages up, like they're slowly, like they said, their strategy is to slowly move up to older and older and older. And I think that makes a lot of sense, because the older people value the graphics better. So it's not there yet, because a lot of it's streaming, a lot of it's third-party development costs and stuff like that, or third-party development tools. And they're not going to be able to create like a Call of Duty style game today or allow people to do that. But I think in many years, or 10 years, they could. It's going to be a long time, but I would say I agree with you in like a 3 to 4 year time span, but I wouldn't count them out giving their stated strategy over the next 10 years.
Yeah. Who else reported? Marqeta. Do you remember them?
Sure. Yeah. Why don't we go over them last? We got about 4 minutes here, I think. So,
well, the only thing that really happened. So remember, Block is like 78% of their bookings or whatever, or their volume. They renewed their agreement with the Cash App, which was like this big kind of overhang on the stock. But it looks like they got way worse terms. So apparently Block's taking some of the payment volume themselves. Let me just go to what this guy says. Okay. Marqeta Cash App renewal comes at a 40% lower gross profit.
Well,
this new contract will confuse the algos. Revenue estimated to decline 50%, but gross profit by 10% for Marqeta. Not sure. I think those two are a little counterintuitive, counterproductive. I guess gross profit concentration for Block will be at about it's about 50% as opposed to revenue, which is higher.
Yeah, that's tough.
It's enormous.
They're basically just an API to facilitate crime. So that's not a bad business to be in. Or excuse me, the underbanked. Right?
Yeah.
The cash card. I mean, the Cash App with that Bitcoin stuff is so like it would be so easy to do stuff illicitly. And getting approved for a cash card is like there's no review. There's nothing.
Yeah, and we've seen the kind of at
the short reports. The short reports. Like, they've done some investigations. Yeah, this isn't just my feelings.
It was like I paid for that murder with Cash App, and then like Cash App was like, they're singing about us in songs. It's like, okay.
Yeah, Marqeta never made sense to me, I gotta say.
No, I mean it's just an area I don't understand that well.
All these companies, why would I invest in you over Visa, MasterCard, and Amex? I don't get it. I would, if you study all these businesses, I don't understand these thoughts. But maybe it'll work.
It's 10:30 on the West Coast. I think it's time.
Yeah, we had 2 minutes left because we started
late. All right. What else? Got anything?
What'd you think of did you look at Airbnb?
Yeah.
What'd you think?
Good. Yeah, I mean, it's good across the board. It looked like supply was up like 19% or something like that.
Another acceleration.
Across 7 million. Yeah, it feels like a platform that's just going to grow in relevance over the years. I just can't get comfortable with the valuation at all.
You want to have you want to have I don't know if this is a morbid thought. It's not a morbid thought. It's a morbid investing thought. I think I had it was either in a tweet or a blog post or something, where I said the three companies I'm most confident that are going to grow. This is like in 2021. I was like Airbnb, Coupang, and Roblox, and I haven't made money on any of them yet. So
yeah, but
I'm never going to own
You'd be down on Coupang.
I'd be down.
You'd be down on Roblox.
Yeah.
You might be down in general. I mean, Airbnb had $100 billion market cap, didn't they? What are they at now?
Yeah, but I think what's the frustrating part is that like all three of these, at one point you could have bought them for a decently. Right, Coupang was close to $10 a share. Airbnb was well below 100. Roblox, let me check what its low point was. Roblox at one point was at, it's getting pretty close to its low point. Maybe that was the time, but yeah.
I'm a little more cynical about Roblox, or skeptical about Roblox, I should say, than I am with Airbnb or Coupang. Yeah,
I agree. Well, that's a great way to end it. We'll be talking AutoZone this week. Check out that Coupang episode. I think it was really interesting. We're talking share cannibals for the rest of the month. So Lowe's, Discover Financial, and then Sprouts Farmers Market. Thank you all, everyone, for tuning in. Remember, we are not financial advisors. Anything we say on the show is not formal advice or recommendation. We are general partners at Arch Capital, and clients may hold securities discussed in this podcast. You can watch the Investing Power Hour on YouTube every Thursdays or listen Sundays on your podcast player of choice. Thank you, everyone, for tuning in. Thank you for the comments. Hopefully it was fun. We'll see you next time.